This week I wrote an article for my Patreon members regarding what is driving stock market prices. I used information available from the Federal Reserve Z1 financial accounts database. The data is US-centric, but it's useful for drawing conclusions that should apply internationally. I'm going to provide a summary here for my YouTube subscribers, but if anybody is interested in a more detailed look, including what's happening with real estate and pensionable assets, please check out my Patreon site. I left a link to it in the video description. So now let's go to the slides. What you see on this slide is a comparison of the S&P 500 index against US GDP. I multiplied GDP by 0.08 because that was the value that minimized the squared differences between the S&P index and the GDP curve. What you can see is a fairly good correspondence, though there are some large deviations, notably in the late 1970s to early 1980s, in 2000, and again now. Warren Buffett really likes this kind of indicator for valuing the stock indices because it makes good fundamental sense. Corporations derive their profit from the economic activity of the country, and so it's natural to expect that the price that we pay for a chunk of corporate America should track the total gross domestic product. The question one has to ask is whether or not the relationship seen over the past 50 years will persist into the future. If so, right now would appear to be, on the surface, one of the most overvalued stock markets that we've seen in a long time, and the time could be ripe for a correction. But what if there's something else going on under the hood that's resulting in stocks rising for another reason? Now, I hinted about that in the title of this video. Take a look at how closely the S&P 500 index tracks two measures of monetary supply, the broad M2 money supply and the narrow currency in circulation. One can see an even closer match between the S&P index and these two monetary measures than the match with GDP. And this is a clear indication that maybe there is another factor at play besides underlying economic activity. Based upon what I found while researching my report, I think that there is clear and compelling evidence that it is the growing wealth and income disparity that is causing stock prices and real estate prices to climb. So let's take a closer look. Here's a summary of how U.S. assets have grown in nominal terms since the year 1990. Right now I'm focusing on how much assets in each category have grown, and not yet on how they are distributed amongst the different wealth tiers. We can see right away that by far real estate and corporate equities are the largest categories, comprising nearly 50% of the total presently. Pension entitlements are also quite meaningful. Now, I touch on all three of these in my article, but in this video I'm going to only dig deeper into the equity component. The equity component grew at an annualized rate of 9.65%, which is quite high relative to GDP, which only grew by an annualized 4.39% rate over this time period. But all of these components, with the exception of the consumer durables, grew faster than GDP. Pension entitlements and real estate were the second two fastest growers behind equities. So let's now take a look at the growth rate of equity assets held by different wealth tiers to see what it can tell us. This is a very telling chart. It paints a picture of increasing concentration of corporate equities into the hands of the very wealthy. Take a look at the total equity holdings held by the top 1%. At the beginning of this period, the top 1% held $867 billion worth of equities, and at the end of this period, they held $20 trillion worth. This is a 23-fold increase in equity wealth held by the top 1%. Now, one has to ask the question, how much of that came simply from price appreciation of the assets that they held at the very beginning? If you take a look at the upper left-hand corner of this plot, I noted that the S&P 500 index grew 11.3-fold over this period. So no, the increase in equity assets of the top 1% was not solely due to price appreciation of the stocks that they already held. So can reinvestment of distributed profits explain the increase? With dividend reinvestment, an investment in the S&P 500 at the beginning of this period would have grown 21.5-fold. Of course, that's neglecting the impact of taxes. So there's evidence that the top 1% were not just holding on to equities and reinvesting the profits. They were adding to their positions with other sources of cash flow. It's a sign that the very wealthy just have too much income to spend on items that would contribute to the GDP, and so they are plowing their excess income into other things. Here it is shown their preference for stocks, though I also show in my article they are showing a preference for plowing their excess wealth into real estate also. How about the next level down? Those who are in the 90% and above wealth tier, but not quite the top 1%. Well, these people increase their equity holdings by 16.1-fold. So their accumulation is less than the top 1%, comparatively speaking. It's a story that tells us this tier owns a meaningful quantity of equities, but doesn't have the cash flow to achieve the boost in wealth that the top 1% achieved. Now, 16.1-fold is somewhere between the 11.3-fold increase in the S&P 500 index and what could have been achieved with dividend reinvestment. Then we focus our attention on the 50 to 90% tier. These people increase their equity positions by only 11.64-fold, just keeping up with the index itself. And finally, we have the bottom 50%, which is the biggest segment from the population, but it has a negligible participation in corporate equities. So this chart is a pretty clear picture of cash flow discrepancy. The very wealthy are accumulating equity assets with their excess cash flow, and this is cash flow that the lower strata simply don't have. The lower tiers spend more of their income on cost of living, and so cash flow that goes to these tiers is going to have a proportionally larger impact on GDP than an impact on share prices. Now, so long as the wealthy receive cash flow well in excess of their spending on consumer expenditures, I think we're likely to see a growing gap between equity pricing and profit. We may or may not see an equity price decline over the next year or two, but so long as money flows continue the way that they have, I believe that the general direction of stock market is going to be up, at least in nominal terms. Now, for more information, please check out my Patreon site. I left a link in the description of this video. Thank you for your attention.